Welcome to the program. My name is Marty Schenkman, and I'm joined by a colleague, Christine Pronek. Christine is a T&E, Trust and Estates specialist at a really large New Jersey accounting firm, Wilkin Gutton Plan. And this is a really practical program on probate-related income tax planning. It's an area I see mistakes in. I'm sure Christine and I were talking beforehand. She sees things done wrong all the time. And what I hope will be very useful for you, the participants, is Christine has picked a limited number of topics, so she's not going to race through 400 slides. She's going to explain them and make it all understandable. Christine and I were talking before we got started, and let's just take a minute and do that. We don't have in the slides, because it's really focused on income tax, what I see is one of the major issues with probates generally. And Christine, if you want to talk about it, you can, and then I'll tell a short war story.
Well, sure. I mean, it's with respect to, we have such a high exemption right now. A lot of people are falling into the thought of, well, there's nothing to do. If we're under this exemption, we don't have to worry. And a couple of things get missed. One right there is portability election. Even for an estate that's under that taxable amount, it makes sense to file and have a portability election to carry that unused exemption over to the surviving spouse, especially if we're looking at a sunset at the end of this year going into next year. At least you'd have that prior deceased spouse's exemption coming over to add to what now is a smaller exemption for the surviving spouse. So that's one thing a lot of people tend to overlook, is that opportunity for portability. Another is, if you're a state of New Jersey.
Wait, one at a time. So let me make a couple comments. That is overlooked a lot, and that is why the government has instituted so many leniencies to try to help people deal with it. So every advisor, financial advisor, insurance consultant, anybody that has anything to do with the client where there's somebody, a spouse that's passed away, should talk to them about portability. Get them to somebody who specializes in this, an attorney, an accountant that will file the estate return to get the exemption safeguarded. Let me give a little twist on what that could mean, just to tie it to current events. The Republicans are talking about repealing the estate tax. Think about the following. Somebody dies before estate tax repeal. You file, you get portability. What happens if estate tax is repealed? It seems like you might have secured that exemption by having filed. On the other hand, if somebody dies after repeal, you can't port an exemption. There is no estate tax. There is no exemption. What happens if the Democrats come back to power? And, it's always a yo-yo in Washington, one party in power, then the next. And they all love to change the estate tax rules and the income tax rules. It just goes with the territory. Think of the whipsaw. If a spouse dies after repeal and then the second spouse survives, they have no portable exemption because the estate tax was repealed. The Democrats reinstate it, and now the second spouse dies after reinstatement. They don't get the benefit of the exemption of the deceased spouse and could face an estate tax where otherwise perhaps they may not have. So there's lots of funky things going on, but I think the bottom line is it should be done. Very quick war story. About a year or so ago, I had a call from a client, an old client, hadn't heard from them in forever, and the wife had died many years ago. And one of the first things I talked to them about was, did you file the estate tax return? And one of the kids immediately got like nasty and accusatory. You never told us, you never discussed it. The father was on the phone and immediately said, no, Mr. Schenkman told me about it. We didn't do it. And obviously, not liking the tone of one of the children that made the comment, I went back to our file, and thankfully we had a letter saying, we're sorry for your loss. You've opted, and this goes to prove what Christine just said, which I think is a big issue that we all advisors and all allied professions need to help with. Their attitude was, well, there's no estate tax. Why pay anybody? They didn't go to an accountant. They didn't really come to me. But we sent them a letter saying, you've opted not to hire us. There could be all sorts of various income and estate tax issues that you need to address, as well as legal issues and setting up trusts. And we'll be happy to help if you, change your mind. So I was glad to have that letter, just a cautionary recommendation to all advisors, send a letter and warn them about all the things that might need to be done. And I did it generically. I didn't list the individual things because they weren't hiring us. But this is an ongoing problem. Clients don't appreciate the complexity of what can be involved. And as a result, I think shy away from hiring their advisors or new advisors if they didn't have any to address some of this. And we've seen, as Christine said, all sorts of problems come out of this. We had another one recently where a bypass trust was not funded for several years. I mean, that's what the will required. I mean, how do you not abide by it, right? I mean, you can read the will and see if there's a way out of it. But again, clients don't appreciate many of these formalities. And I think it's especially important for all the advisors to help educate clients on that. And Christine, you had a second example besides portability.
Yes, and just as an aside, I have a letter that I use like that as well, Marty, because as you pointed out in your war story, you're dealing with the executor at the time because they're the one who makes the election, which is typically the surviving spouse, but it's the kids after the second spouse passes that would come back and say, why didn't we do this? That letter is really very, not just
Yeah.
handy, I think important to have in the file. The other thing I was thinking is for New Jersey residents, again, everybody's focused on that federal exemption. There's no New Jersey estate tax, but we do have a New Jersey inheritance tax, and that often is overlooked, or it's just something people are not aware of to keep in mind if you reside in New Jersey, or if you're a non-resident of New Jersey and have real or tangible property here. New Jersey does have an inheritance tax, even though we don't have the estate tax, and that shouldn't be overlooked either.
And obviously, since it's a national audience, check other states because it is surprising, and it's very hard to anticipate. Forgive me. What might happen if the Republicans are able to repeal the estate tax? What happens to the state level estate and inheritance taxes? Will the states continue? Will they have to amend their tax to refer to the federal tax as of a certain date because many states have piggybacked it? Will the states, even if their estate tax works or an inheritance tax works, will they decide to give up on death taxes because now the federal tax is gone and maybe they don't want to be in that position? All unknown. So, Christine, let's talk one last quick point, which we were discussing beforehand, and then let me turn it over to you and let you get into your discussions. One of the things that I've seen, and I'm not trying to be critical of anybody, but the estate tax um, area specialty is special. It is a specialty. It's fairly narrow, and one of the things that I think is important is where general practitioners in any of the allied professions feel they're beyond their swim lane in terms of what they can do. Um, it seems, and especially with some of the elections that you're going to talk about, it may make sense to either consult with or bring on board or just refer out just this slice of the estate planning. I mean, I don't the estate administration. I don't think that has to in any way jeopardize the referring professional's involvement with the family, but it may be better. Do you want to just speak for a moment to that and then we'll get started?
Sure. I've actually gotten quite a few referrals over the years from accountants that are in smaller firms and they don't have somebody who specializes in this area. And as Marty said, it is a specialty. And they will refer the estate work to me. We'll do any estate tax returns that are needed, inheritance tax returns, sometimes even the income tax returns for the estate, because that particular accountant doesn't specialize in that area. They want to make sure their client gets the right service and they refer over to me and my firm to take care of that piece of it for them. And it's honestly a great idea. You don't want to swim out of your lane. And if this isn't something you do regularly, you could easily miss some elections and some opportunities that would have been of a great advantage to the client.
Yeah, and I think that goes not just for accountants, but certainly for attorneys as well. If you're a general practitioner, certainly you can probably handle a lot of the probate matters, and certainly the legal side. But maybe at least consult with an accountant who specializes in estate issues to see some of the possibilities that are there. So, Christine, let me kind of turn it over to you, and I don't know that you want to go through the list of what we're going to cover. We could just jump in if that's okay.
Sure, that's fine.
Okay, take it away, and I'll change slides when you tell me, and I'll comment once in a while so people know I'm still here.
Okay. So starting off with choice of fiscal year. When you're dealing with an estate income tax return, you're not locked into calendar year the way you are with a trust, and I'll get into where there's an exception to that later. But you can choose. So from the date the person passed away, you can go as far out as the last day of the month preceding that. You can't go more than 12 months. So just using it, if somebody passed away December 13th of 2024, the furthest you could take that fiscal year out would be November 30th of 25. You don't have to do that long. That first initial year of the estate is where you have the opportunity to pick a fiscal year that makes the most sense. In some cases, the calendar year might make the most sense, but a lot of times you're going to take a look at what's the income, what's the deductions, what's the timing of those things, if that is known, and say, okay, we're going to stop the first year here on this date. And then from that, after that first year, now you know you've got another 12 months for each year going forward until your final year, which could be a short year. But very often I've seen estate income tax returns done by another accountant where they just went calendar because it was easier. The 1099s are reported on a calendar year, so let's do this because it's easy. And they missed out on some opportunities to choose a fiscal year end that could have benefited the estate. One of the benefits would be deferring income, because something to keep in mind is, say in my example, somebody passed in December of 24. When you file that return, it'll be on a 2024 tax form, 2024 Form 1041. But the beneficiaries pick the income up should they get distributions in a K1. They pick it up in the year that the estate income tax year ends. So for mine ending November 30th of 25, we're going to have that on the beneficiaries 2025 1040s. So when you start to think about how much you could kind of kick that can down the road if needed, you have that chance to defer income, as well as making sure you've got a nice matching of deductions and income within the year that you chose. Because if you're looking at, okay, what's been the income so far? What have been the deductions? We don't want to waste deductions because we know unless it's the final year of the estate, those deductions are truly wasted. You exceed your income, they're done. You don't get a benefit of them. So you want to try to match that as best as possible while also looking at the opportunity to defer income for the beneficiaries. I'm sorry, Marty, did you want to say something?
Um, so Christine, this is not only for taxable estates from an estate tax perspective. Even smaller estates may find an income tax benefit from doing this, right?
Yes, because even if it's an estate that didn't have to file an estate tax return, a 706, your smaller estates, as long as they're generating income, they have to file the income tax return, the Form 1041.
And that just to highlight the point that Christine and I spoke about earlier. Many clients feel they want to save money because, gee, there's no estate tax. There's nothing to do with an estate tax. Who doesn't want to save income tax if there's an opportunity to, right?
Right.
And frankly, on a smaller estate, if you're able to get some decent income tax savings, I think the heirs will appreciate that.
Yeah, this is your other area for an opportunity to save and plan. And just to give an example of when I was talking about the fiscal year and how you could have some deferral, I think I have an example of it on the next slide. But say you have an estate that gets a Schedule K1 from a partnership. Now that K1 is on a calendar year. The partnership uses, the 12/31 year end, but you have an estate with, in my example, a November 30th year end. You could have a November 30th year end for your estate, but the calendar year, the tax year for the estate that 12/31 year end K1 would be included in would be the next year, because you'll include it in the year in which that K1 date falls. So you can actually kick at K1 reporting a year down the road for the estate and for the beneficiaries just by using a certain fiscal year.
So again, just speculating about what might happen if the Trump administration is able to reduce income tax rates, which is certainly a possibility. We don't know yet. You may not just defer for a whole year, which I can't think there's a client that wouldn't like deferring paying an income tax for a year, but you may end up in a lower rate. I don't think there's any likelihood that rates are going up under the current administration. So you could get an extra double benefit, both a deferral and a possible lower rate. All good stuff that will make clients happy.
Yes, because that K1 to the beneficiary now would go in their next year's 1040, which, as you're saying, could have a nice lower rate.
Yeah.
And then in the final year, I mentioned earlier how you don't want to have a waste of expenses. Currently, those excess deductions on termination, which is what it's called when you have more expense than income in the final year, they're not allowed right now because they fall into that 2% of the miscellaneous itemized deduction bucket. But should that come back into play, then those excess deductions do serve a benefit to the beneficiaries in the final year on their Schedule A of their individual return. Other things that happen in the final, go ahead.
Is there anything you can do with these excess deductions if you know that there's going to be a disallowance? Is it trigger income to offset them?
I would say either triggering income, or that's what you're going to want to watch for when you're choosing that fiscal year and you know what year you're working with in the future. Try to match them. Try to get those deductions paid in the years where you have that income so that you can avoid this waste in a final year. The other thing that happens in the final year is if there's capital losses in the estate, they'll pass out on the Schedules K1 to the beneficiaries for their use. Something to keep in mind, if an estate has an interest in a passive activity that's being distributed to a beneficiary, those passive losses are not freed up upon distribution to a residual beneficiary. Instead, they're a basis adjustment. So if that estate has passive activity losses and there's an interest in that passive activity being distributed to the beneficiary, you should be making that beneficiary aware that this is a basis adjustment. This is the amount that you can take in addition to what, you've got your date of death value as a basis, any flows from the K1s in between, and now finally a PAL adjustment at the end. They need to be made aware of what their basis is in that asset. They won't know otherwise.
Are you able to coordinate with the beneficiaries? Do you have a problem speaking to them to help them understand what might be coming and what they might do?
No, typically when I'm working on an estate, we actually do handle the returns of the beneficiaries. If there's a situation where we don't, say like another accountant referred, or we just happen to handle the parents and not the kids, we will make sure that they are aware of, and there's some other things in the presentation I'll be mentioning this with, that they understand their basis in the assets that they're getting. We also need to speak with them because when we're choosing fiscal years and possibility deferring income and things, we need to know what's going on their individual income tax returns to make the right decisions at the estate level. We wouldn't want to push some income into somebody else in another year and find out that was a bad idea for them. So the whole picture really is needed. When you're working on the estate, you need to have communication with respect to what's going on to the beneficiaries' individual returns as well. Next thing I wanted to talk about is the Code Section 645 election. And what this does is if the client had or the taxpayer had a revocable trust that now has become irrevocable, of course, upon their passing, you can make an election to include that revocable trust and its activity in the estate income tax return. And this is convenient for quite a few reasons. One, once that election is made, you're filing one return for both. You're going to be accounting for the estate activity for any assets that were outside of that revocable trust, also for the revocable trust activity as well, all on one tax return. Another thing the election will do is it'll allow some planning opportunities now for that trust that it would not have had otherwise if it filed separately as a revocable trust. The one we just discussed, choice of fiscal year. That's an option for an estate. It's not an option for trusts. But if there's an election to include the revocable trust in this estate, now that trust is also benefiting from the fiscal year choice. I mentioned reducing burden of two tax returns. And then there are also some other provisions I'll go into now about some other benefits for the trust to be treated as an estate rather than to be treated as a trust.
This concept is very important and growing in importance with an aging population. There are more and more revocable trusts. We use in our practice revocable trusts as really the default approach for anybody that's, I'm going to say it broadly and nicely, on in years. It's just a better tool than relying on a power of attorney or a will in terms of managing assets as in disability. A power of attorney, we've all heard of the issues where a bank won't accept it or somebody doesn't like it or there's not sufficient detail or constraints in a simple power of attorney. Revocable trust is just a much more robust and powerful way to plan, and you can build in protections. For example, with elder abuse, you can't revise the revocable trust unless a non-adverse party, the longtime attorney or accountant for the family, agrees to the revision. You can put a lot of safeguards in a revocable trust. So this is really important because this is really a growing trend, and it should be with the aging population. Christine?
Some of the other advantages now that that trust will have, since it's being treated as an estate, is if there happens to be a rental property in the estate and the decedent had been active in that property, so they were taking advantage of that deduction of up to $25,000 of losses against non-passive income on their tax return. The states are allowed to do that as well. For those first 2 years after the decedent passes away, they can take advantage of using $25,000 of rental losses against non-passive income. So now this would be afforded to the revocable trust because the election's been made to include it. Also, with respect to if you had a decedent who owned an interest in an S corporation, if those S shares were in the revocable trust and now the revocable trust has not been elected to be included in the estate, it's on its own, it's standing as an irrevocable trust, you have 2 years from date of death to get that trust qualified as an S corp shareholder. It was qualified during the decedent's life because it was a grantor trust, being that it was revocable. Now that it's an irrevocable non-grantor trust, you have to make sure you get it qualified as an eligible S corp shareholder. If the election's made to include that trust in the estate, it gives you some more time. You at least have that period of administration of the estate to figure out how you're going to have those S corp shares by an eligible shareholder, and it could own by an eligible shareholder. And it could be via distribution to an individual who's eligible, or at least distributing to a trust that already now you're ready to have the elections made and have that trust qualify.
Christine, maybe just tell people just briefly the bad consequences if the S corp rules are not adhered to. You lose your S election.
Exactly. If you wind up having, let's give an example of you've got the S corp shares owned in the revocable trust, it's fine during the decedent's lifetime because it's a grantor trust. Because your 3 options for trust to own S corp shares are grantor trust, something called a qualified subchapter S trust, a QUISIT, or an electing small business trust. So if now these shares transfer into they're in the revocable trust, the trust becomes irrevocable. If that trust is not included in the estate with this election, so it's on its own, you have 2 years to make either that QUISIT election or to make that ASBIT election. If you don't, then I think there is some automatic relief for about a 3-year period to try to fix that, because as Marty said, what you've got now is an ineligible shareholder in an S corp, which invalidates the S corp's election. It basically forced them to be treated as a C corp because they ran afoul of having eligible shareholders. Once you get past even that 3-year window, say if you've not realized that that was a problem, you're just cruising along with an irrevocable trust, owning S shares, and it's not a QUISIT, it's not an SBIT, now you're into private letter ruling territory. Those are very expensive and very time consuming, and you're hoping in the end that the IRS will bless it and say, okay, we'll allow you to be treated as one of these types of eligible trusts, the QUISIT or the SBIT, for a period of time when you weren't. But ultimately, the big blow up could be you just ruined an S election for the corporation.
And just to point out, maybe it's obvious in what Christine said, but just it's so important. Let's say this particular trust owned 20%, and there's 4 other shareholders. Everyone owns 20%. You have 5 shareholders. The negative consequence isn't just to the estate that didn't handle it right, but the loss of the S election affects everyone else too. So that could be a bad lawsuit and a bad problem. So when clients feel that, oh, it's simple, there's no estate tax, I don't need to talk to anybody, this is it's not only the 645 election, but it's also the planning for S corps. And there's just so many nettlesome issues like this that it's very important to get somebody involved that knows what's going on. It's not really advisable in so many cases for clients to do it. One of the things that we've done for clients that are really reluctant to pay for professional fees, and not just us, the accountants and even some of the financial advisors to help, is to at least create a memo for the estate that goes through and creates a roadmap identifying all these issues. And we have the accountant involved, the financial advisor involved, if there's insurance, the insurance consultant involved, get everyone to just work on a memo so they have a roadmap. Because issues like this can at least be identified and hopefully drive the client to get the right help that they need. Christine?
Right. Well, that's an excellent idea, because these things can blow up all the time with the S corp that somebody just didn't realize.
Yeah.
And the last advantage I wanted to mention of the trust being included in the estate income tax return is now the trust can deduct losses for funding pecuniary requests with non-cash property distributions, meaning if you have a bequest coming out of the estate that's tied to a dollar value and you want to use property to satisfy that, you have to recognize that basically as a sale in the estate. If there should be a loss, the estate can deduct it. If a trust taking care of using property for distributions does not get to take losses, but it would recognize gains. And we'll get into that with another election in a few minutes. But that's just another benefit now of the trust part of the estate. It gets to take advantage of the tax laws that the estate's taking care of. To make the election, there's a box on page 1 of the state income tax return, the Form 1041. There's also a separate form, Form 8855, that you file to make this election to treat the revocable trust as part of the estate. That revocable trust needs to have obtained, or you need to have obtained for it, an employer identification number for after the decedent's passing, because as I mentioned before, it's gone from revocable trust to irrevocable. You need to get an EIN for that post-death period for that trust. That is reported on the Form 8855. And both the executor for the estate and the trustee for the trust will sign off on this election. And you include that with the tax return. And the IRS does look at those. I've seen situations where they come back and they say, oh, wait, we're missing this. Or, oh, you needed that. And this needs to be filed timely. So if the estate tax return isn't filed by the initial due date, but you do have an extension to file for an extended period of time, you want to file that. The first initial year where you're making this election needs to be filed timely for this election to be valid. And the election period itself goes on for a period of, it's either the earlier of the date that the assets have been distributed from the estate and trust, meaning it's wrapped up and done, or what they call the applicable date. And the applicable date that you're comparing to looks to whether or not an estate tax return of Form 706 was filed. And if we flip to the next one, Marty, I think I have that outlined there. So the applicable date, if you filed an estate tax return, it's going to be the later of 2 years after the date that the decedent passed, or 6 months after basically the closing letter, the final determination of liability. So the later of those 2 dates is when your period for having the estate and the trust combined is done, and now the trust should really be off and running on its own, assuming it was going to be continuing that way. If there was no estate tax return filed, then you're looking at 2 years after the decedent's date of death. 65-day elections. This is under Code Section 663B, and what this is, it's a great hindsight planning tool that's available for estates as well as complex trusts, where you can have distributions that are made in the first 65 days after the end of your tax year, treated to have been made during that tax year. So in those first 65 days, if a distribution came out to a beneficiary, you can pull that back to the prior tax year for that estate and say, we want that distribution to be treated as done this year, and push some income out to the beneficiaries. And the reason I'm saying it's great hindsight planning is because now your state has had its year end. You can see what the income and the deductions are, and you could figure out, do we want to leave that at the estate level and pay some tax at the estate income tax return level? Or does it make sense to push that out to beneficiaries and have it taxed on their individual income tax returns? Could be spreading it around if you have multiple beneficiaries. Could be those, and given the compressed brackets of an estate, at I think it's 15,200 for 2024, you're hitting that 37% income tax rate, plus you're hitting the higher capital gains rate of 20%, and you're hitting the net income tax, if that's applicable, at 3.8%. So when you've got those crunched, compressed tax brackets in the estate, and you're at a point where now your year is over, you know what the income and deductions are, you know what your net income would be, you have the opportunity to say, should we leave it here and take a hit at those compressed brackets? Or if the bennies are in lower brackets, or say they're in high brackets, but there's multiple beneficiaries, if we can spread it around, does it make sense to do that? And those 65 days gives you the opportunity to make a distribution then, but bring it back to the prior year.
Christine, I don't want to get too off track, but just can you give just a quickie explanation of DNI, distributable net income, how it gets out of the estate? And I think it's very important to emphasize, again, this is not for, large taxable estates only. This makes sense and could be a huge, huge impact on the marginal income tax rate on estates that are even much more modest. They may sell a large asset and have a gain that's post-death appreciation, for example. Where are you going to report that gain? Do you want to compress so everything over 15.2, I think you said, but 15 and change is at the maximum bracket when you have beneficiaries of much lower brackets? And also, what about state income tax? Can't this help that too?
Yep, it would be the same for the estate income tax return, because you'll get that distribution deduction on that return as well. And then that would bring the income over to beneficiaries' returns. As Marty had mentioned, that's the concept of distributable net income, or DNI. That's your taxable income in the estate. Your income minus your deductions gets you down to your distributable net income, excuse me. That distributable net income, when that's distributed out to the beneficiaries, that's reflected on their K1s in the various buckets, interest, dividends, whatever pieces are being distributed. But now that DNI portion is picked up on their individual income tax returns. To the extent a beneficiary takes more distribution than yet DNI, they're capped at DNI, their share of DNI, for how much they would be taxed on, just as the estate's capped at DNI for how much of an offsetting deduction you'd be taking. With respect to this election, the 65-day election, the maximum amount that the election can be made for is the greater of fiduciary accounting income or distributable net income. Your fiduciary accounting income within the estate could be different than your distributable net income because the DNI is tax driven, so it has deductions based on the tax law, whereas on your FAI, you're typically looking at the Uniform Principal and Income Act, so there could be some deductions that might have been applicable to principal, not to income, and your FAI could be the higher number. But when we're looking at what's reflected on the K1s, what's taken as a deduction on the estate income tax return, that's your DNI number.
And just so you know, fiduciary accounting income is a creature of state law. So you have to look at governing state law, and there can be differences between state law. But the complexity of what's inherent in this, the fact that it could be applicable to estates of all sizes, and the difference in marginal tax rates that could be achieved could be very significant for some estates.
Yes. And I think on the next page, do I have, I think I mentioned that it's a great tool for hindsight planning, the maximum amount. And for making the election itself, it's a check the box in section 3, excuse me, page 3 of Form 1041. There's a question there that asks that you're making this election. You do that, and then you would be attaching a statement to the return to show this was the date of the distribution, because you're going to be showing them that distribution that you're making the election for fell within that 65-day period after year end. The date of the distribution, the amount that the election is being made for, and the beneficiary to whom it was made. If you should happen to distribute more than was needed to pull out the income, more than you needed to accomplish what you wanted to, that's fine. Any excess over what was needed can be used as a distribution in that next year, the year that the distribution actually took place. So it's not a concern to distribute more, but you want to make sure you distribute at least as much as you needed to move that taxable income, that DNI, out of the estate and over to the beneficiaries to achieve your tax savings. Excuse me. So that's an example, just an example of the attachment you would have in the return to show the distribution that's falling within the election. I know just if you had I mentioned before, it's for a complex trust as well. So the complex trust, you've got a year end of 12/31. For this year, you've got up to March 6th, I think, to make your 65-day elections, because that's the 65 days after year end. So it's an important date to keep in mind for planning purposes. With estates with a fiscal year, you definitely want to be watching when your 65 days will be up. 643E3 property distributions. What this is it gives the estate the ability to make an election so that when distributions are made to residual beneficiaries, if it's property, the typical rule would be you distribute the property to the residual beneficiary, there's no gain or loss, it's not any kind of taxable event, other than it brings out some DNI to them on a K1. You have the opportunity to make this election to treat that property basically as being sold at the moment that it's being distributed to that residual beneficiary. And what that would do for the beneficiary is now they're getting the fair market value at that date of distribution as their basis. And they're also going to have a holding period beginning on that day. It'll be a new holding period of that day going forward. For the estate would now recognize the gain, not a loss, I'll explain that in a moment, but recognize the gain on that distribution of property and pay the tax at the estate level. So now your beneficiary is getting a fair market value basis and going forward. Basically, no unrealized gain built into it when the beneficiary gets it. The reason a loss can't be recognized is because it's looked at as a sale, and from your estate to your beneficiary, they're related parties. There would be a loss recognized when this election is made. It does get recognized. Some of the reasons you might want to do this, and let me just go into a moment on what basis you would use. So if this election is made, and there's a gain recognized, As I mentioned, now you know your beneficiary is a fair market value at that date of distribution per basis. If there's a loss realized, but not recognized, as I said, because of related party rules, we can't recognize the loss. The basis to the beneficiary now would be two different things you have to keep track of. The beneficiary would look to either the estate's basis in the asset would be used to compute gain, or the fair market value of the asset on the date of distribution is what the beneficiary would use to compute loss. So again, this is information that's going to have to be provided to that beneficiary to let them know there was a loss realized, we made this election. These are the two bases you need to keep in mind for when you should sell that property down the road. If they happen to sell it for an amount that's in between the estate's basis and the fair market value date of distribution, there's no gain or loss recognized, but they do need to be made aware with this election of what the basis rules are for them. And I think on the next page, it gets into why you might want to consider this. I mentioned the holding period is now fresh because it's looked at as a sale. The election itself is on page 3 of the 1041. You check a box there. The sale on Schedule D should be highlighted as being an IRC 643E3. You're identifying that sale because, again, if there's a gain, you're going to be reporting it. If there's a loss, you have to show it as break even because the estate can't take the loss. And it applies to all the distributions made during the year that the estate is going to be making. You can't pick and choose and say, we're going to recognize gain on this one for this beneficiary, but we don't want to do it on this distribution of property over here to that beneficiary. It would be for all the property distributions made in that given year. Excuse me one moment. I think on the next slide, I get into where you'd want to consider it. So let's say the estate has capital losses and you'd like to get the use of those, or you know they can be used now to offset any gain that might be recognized on this property distribution. That's a good opportunity right there. You have the gain, you offset it with losses, no tax paid, but now the beneficiaries have fair market value on date of distribution instead of what might have been a lower cost basis in the estate. If you know the beneficiary plans on selling an asset and it has built-in unrealized gain, we could look to having that tax paid at the estate level. We have to take into account how many beneficiaries there are and who's benefiting and you know, all those nuances. But that's one situation where you'd be looking at it. If you have multiple beneficiaries in the estate, where typically you're distributing property and you have to look at not just value, but built-in gain or loss. Excuse me. But built-in gain or loss to make sure everybody's being treated fairly. Excuse me. This is a way to equalize for those beneficiaries. So instead of this one's got this basis, but they have this fair market value and those types of things, you make this election, you can recognize any gains at the estate level, and now really the beneficiaries have been equalized. They're all taking fair market value at date of distribution, which is easy to just look and see if it's equal or not equal. It makes that easy. Okay.
Christine, if you had problems getting the cooperation of the beneficiaries, I mean, it seems like it's certainly in their interest to want to communicate to the accountant for the estate to figure all of this out. And I guess if they have their own accounting firm, you can speak to their accountant with their permission and coordinate that way. But have you ever run into problems where you're just not getting the data or input you need from the beneficiaries to really make a full decision?
I've seen in some situations, and I understand they don't want to show their 1040, they might not want to mention their bracket. So it's kind of, we wind up giving the information to say, if you have this situation, here's the concern, or if you have that, because they don't want to disclose or they're concerned that we would then be revealing their situations to their siblings if they're the other beneficiaries. They're very protective and private. And then we're kind of just saying, here's what we're trying to accomplish. If this is something that would benefit you, please think about it. But more often than not, everybody's been pretty cooperative with us trying to plan for them and do the things in the best way.
No, I've seen exactly what you said, where for some reason, and why would you want it? Why would you ever disclose beneficiary B's information to beneficiary A or the executor? You're just trying to help do tax planning to help everyone. But I've seen, family dynamics are often intriguing, and practitioners need to be prepared for that. And I thought what you said was great. You send them sort of an explanation and say, here's what we're trying to do, here's what the consequences are, and then it's in their hands to make a decision.
Right. We gave them the opportunity. We're trying to help them, but sometimes you do get that very private, very protective of their information. the response.
But ultimately, it's the executor that has to make the judgment call.
Yes.
Yeah.
And so if it should end up being a negative consequence to them, at least it's kind of, well, we tried to, take that into account, but weren't able to, type of thing.
No, I think fully communicating in advance what's being contemplated is protective of the executor. And if they don't respond because they don't want to let anyone know anything, I mean, what can the executor do but make a decision with the only can do is make a decision with the information about the beneficiaries that have communicated. You can't guess what the others may have.
Right, and you hate to do something to the detriment of the others that were cooperative because of the other, they just have to make the
Correct.
best guess at that point.
Right. But the executors need to be mindful of what you said, because I think to protect the executor, having you as the accountant for the estate communicate to the beneficiaries and explain what's going on makes a lot of sense.
Yes. The 691C estate tax deduction. What this is for income in respect of decedent assets, which are assets that are included in the estate, so they're subject to the estate, but then also when they're received by the beneficiaries or received by the estate, they're also subject to income tax. Excuse me. In those situations like IRAs, wages, 401k distributions, pardon me, I have a list there. These assets that get subject to both estate tax and then again to the income tax when received, there's a deduction for that estate tax that was related to these assets that's available to be taken by either on the estate income tax return itself or in the beneficiary's income tax return. So you have a beneficiary who's a beneficiary of the IRA. That IRA was included in the decedent's estate and subject to estate tax. Now it's coming out and being subject to income tax. The beneficiary can take a deduction that correlates to the amount of the IRA distribution they took on their income tax return. It's deductible on their Schedule A itemized deductions form. It's not subject to 2%, so this is still available right now. And the information that beneficiary needs to have is what is the estate tax amount that they're working with that they can deduct over time as they take those IRA distributions. And as I mentioned, the estate itself could be taking it as it receives, for an example, IRA distributions. So the computation of it is you would look at your estate tax that was due, the estate tax liability, with the IRA, with any other IRD assets that are in there. Then you remove those assets and see what the tax would be without them included in the estate. And then you're comparing the two to get your difference in tax. This is a quick overview of it. Look at the difference to say, all right, this much estate tax is due to income in respect of decedent assets. And then you'd have to take another step. If you have a mixed bag of income in respect of decedent assets like wages, IRAs, 401k, you want to allocate appropriately the amount of tax to each of those, based on their value. So for the IRA beneficiary, we have this much of an estate tax that can be deducted. For the 401k, we have this much. And make sure you're notifying those beneficiaries that now they've got this estate tax deduction that's available to them on their individual return as they pull out distributions, excuse me, from those IRD assets, or as if the wages are being picked up, this is on the estate, so the wages now are an income for the estate can take that estate tax deduction for the amount of tax that is attributable to the wages. It's a benefit that's out there. It often gets overlooked. Maybe it's not seen as often anymore with a lot of estates not being taxable, but it's a good one to be mindful of, and you don't want to miss this benefit for your beneficiaries or for the estate income tax return either. I think I covered most of it, right, and where it's taken. The last one, I think this is the last section to talk about, is deducting expenses on the Form 1041, the estate income tax return, versus the estate tax return itself. This is an analysis that needs to be done. Sometimes the estate tax return is being done by the attorney, the income tax return to be done by the accountant. They need to be communicating and talking about the two.
That's a novel idea. The accountant and lawyer should talk to each other.
Excuse me. Great thought, right? They need to be communicating about the income tax picture of the estate as well as the estate tax picture to figure out where's the best place to take certain deductions. There are some deductions that can be taken on either the estate tax return or the estate income tax return. There are some that can be taken on both, but you want to take them in the right place to get the best bang for the buck. So for some that can be taken on either, those are like your accounting fees, your legal fees, appraisal fees, valuation, those types of things. you have to decide where are we going to get the most benefit, on the 706 or on the 1041. And then certain expenses I'll talk about in a moment, those are deductions in respect of decedent. They could be taken on both, but we'll address those in a second. But things you
If
want
you
to
have,
take.
if you
Okay.
have a non-taxable estate, I mean, it's only the 1041, isn't it?
Yes, if you're not filing a 706, then you're just going to be taking them on the 1041. And just to avoid, I think you said it's a national, I know it's a national webinar, but for New Jersey people, just to keep in mind, if you didn't have an estate tax return, but you filed a New Jersey inheritance tax return, you took deductions there, that does not preclude you from taking those deductions on the estate income tax return. You can still do that. This is specific to your federal level estate tax.
And if they repeal the estate tax, then this decision becomes kind of simple because the 1041 is the only thing left, right?
Makes it a lot easier, yes.
Yeah. But I guess that's only one of the few simplifications that repeal may actually create, if we get it. Who knows?
So yeah, the communication between the two is important, and because one of the things you're looking at is the impact on a marital deduction or a charitable deduction if you have that in the estate. Because it's when you take, we'll go into the two different buckets. There's estate transmission expenses and estate management expenses. The transmission expenses are expenses that would not have been incurred otherwise if this person hadn't passed away. So your executor commissions, legal fees specific to the estate work, probate fees, appraisals that had to be done for the estate tax return, those are expenses that would not have otherwise been incurred. When they're paid, when they're deducted, or excuse me, when they're paid out of the estate, if you have a marital or charitable deduction and it came from some residuary that's going in that direction, you have to reduce that marital or charitable deduction. So now you're reducing, let's say, call it the marital, you're reducing the marital deduction for expenses that you were paid from the estate because you know they're not going to the spouse, they went to those payees. If you don't take the deduction on the Schedule J somewhere else on the return, like take that appraisal fee or take those legal fees, now you've got a reduced marital deduction and no other place in the return where you're taking a deduction to make up for that. What you've just done is increase your taxable estate. You probably, if there was some portability amount, you've reduced your portability, and that needs to be taken into account when you're doing that 706, is you have to be mindful that those expenses reduce that deduction. If the expenses are then taken on the return, so you reduced your marital because you paid some legal fees, but then you're going to deduct the legal fees on Schedule J, you've got a wash. You didn't increase your taxable estate. You've managed to wash that difference. But it's something I've seen often overlooked when I look at some estate tax returns where I know expenses were paid. You look at Schedule J, it's like nothing. They didn't deduct anything, and they made no adjustment to the marital deduction at all. They just took those deductions over on an estate income tax return, but they forgot about the impact on the 706 of what those deductions had on the marital deduction. The other types of expenses are the estate management expenses, which a lot of these now, they're not going to be advantageous on the income tax return because they're subject to 2%, like the investment advisory fees, custodial fees. You wouldn't be getting a benefit of them on the income tax return. The interest expense is something you could get a benefit from on the estate income tax return, but also you have the option to take it on the estate tax return. With these types of expenses, the management expenses, you have to look at whether or not they're actually attributable to the marital or the charitable share. Because if they are truly attributable, expenses incurred that were attributable to that marital share or charitable share, then those deductions won't be reduced. They can be paid from those shares, and they won't be reduced unless those management expenses are deducted somewhere on the federal estate tax return, because you don't want to double dip. You're getting a marital deduction at the same time you're getting the deduction for the, let's call it the interest expense. You don't want that double dip would not be allowed. So you have to pay attention to how that expense was treated on the rest of the return. For estate tax or charitable deduction, they'd also be reduced by management expenses if they're paid from those shares but were not attributable to those shares. Now you've just had a reduction in those deductions. So again, we have to pay careful attention to those deductions on the estate tax return, how much of a benefit the estate's getting from them, and the impact that other expenses being paid would have on it. Because that would help you to determine, do I want to take them on the estate tax return, or does it make sense to put them over on the income tax return? I think I gave the examples of expenses that are deductible on one, but not both. executor commissions, legal and accounting fees, appraisal and probate fees. You have the option of where you want to take them, but you can't take them in both places. It can be on the 706, giving you a benefit there for estate tax, and also on your 1041, giving you a benefit for income tax. Another bucket of expenses are called, I'm sorry, guys.
No, at some point, and you can finish your discussion, comment, because we have, attorneys and accountants listening. What might they want to do in their billing? Like set up different matters to differentiate certain expenses that they're billing? Like if you're doing work for the client's S corporation or LLC, should you separate that out from what you're doing from the estate? Just maybe at some point, whether now or when you finish this discussion, comment on what the accountants and attorneys might want to do in terms of their billing to get this right.
Sure, no, I can comment on that now. I know I always have an estate set up as a separate client. So your billings with respect to that work and everything you're doing for that are come out under the heading of estate of so-and-so. You don't want to mix your bags up with their business entities because it's just going to cause a lot of confusion, both for what's truly deductible on that entity versus what's truly deductible and attributable to your estate. So if you're doing work for this client, I would always, even from their individual account, set up a separate estate of account and track all the expenses with respect to the estate work within that billing code.
Yeah, it's very difficult to go back. It tedious to get a time run from all the professional fees and then have to allocate them to different categories. Much easier if you could do it from inception.
Right, if you can issue that invoice that's specific and direct to that estate work, that's the easiest way to go. So the other types of expenses that can be taken on both returns, both the 706 and the 1041, they're called deductions in respect of decedent. These particular deductions are something that the decedent actually owed. He was liable for it at the time that they passed away. So then they're actually, that's what a deduction in respect of decedent was. They were liable for it at the moment they passed away. And these types of things are some business expenses, interest expense that they may be allowed, taxes like real estate taxes that were due but not yet paid, certain investment expenses, and not to get into the weeds, but some percentage of depletion. You want to look to see what types of what expenses the decedent had that were owed and also considered deductible at the time they passed. Those could actually be taken as both because they're listed as a debt of decedent on the estate tax return, but then taken as a deduction when they're actually paid on the estate income tax return. The election statement for this is the whole thing is done under Treasury Reg 1.642G1. That's in the slides, but you can handle it one of two ways. You have I call it the estate tax affidavit. You're attaching that to the return. You're having the executor sign off on it. It actually has to be filed in duplicate. You want 2 copies attached to your return. And it shows the expenses that you're taking on the 1041 that could have been deducted on an estate tax return, but were not. Now, with respect to the timing of that, typically what you'd want to do is wait for either, you could file the return without that attachment, without the affidavit, wait till you get near that the statute of limitations for that return to run, then file. As an amended, you can file with these estate tax affidavits, because what you're doing is protecting the estate's ability to take those deductions should they need them upon an audit. Because the other thing you could watch for is, let's say you need to file your 1041, you file that, you haven't attached your estate tax affidavit, the estate gets audited. If they need those deductions, they can still be brought over because you didn't make that irrevocable election on the 1041, and you could go back and amend the 1041 and just take the deductions off. Or the estate gets looked at, or you get the closing letter without an audit. Now you know the estate's good to go. There isn't going to be an audit. Now you'd be comfortable filing the estate tax affidavit, excuse me, with the estate income tax return, making that definitive election to take those deductions there, because now you know you won't need them on your estate because you've got your closing letter. So it's fine to file the return with the deductions taken and without the affidavit, but then you just want to have it on your reminder, either when you get a closing letter, or if you're going to have get near the statute of limitations on that 1041, that's when you're going to want to go and file the estate tax affidavit.
I think we're done. I think this was great. I think it was very practical. I appreciate how clear you made so much of this sound. And I hope for practitioners that have delved into this a little bit, it'll give them some pause to understand how complicated and nuanced all this can be, because it's very complicated. And if you need help, get help. But I think the big message is clients that think they're going to do this on their own because there's no estate tax, they could be missing all sorts of deductions. They're going to get all sorts of stuff done wrong. I mean, the most common thing, which Christina and I said in the beginning, was not making the portability election. But there's all these income tax issues. And I'm concerned that a lot of clients, now that repeal is being talked about, which may not happen, we don't know. It may not. But that is just further dampening any worries about taxes, and is going to have too many clients making the wrong decisions on getting professional help on their probate. So we all have to educate them. You need to do it. And in general, on estate planning, even if repeal happens, we don't know what's coming with the next administration. So planning should not end. Christine, I thought that was great. I appreciate it. And I want to thank you and thank everyone for joining us.
Thanks, everybody. Thanks, Marty.
Take care.